Good afternoon, everybody. We've purposely built a business over the last 30 years, which puts its clients at its core. We've been facilitating good outcomes all that time. 30 years ago, the wealth management industry, the IFA industry, was a little bit like the Wild West. And we've always ensured that we look after our clients as well as we would look after ourselves. We take our clients, and our clients can be individuals, but more typically they're families. They can be managers, they can be owners of business. These days, they could be trusts, corporates, charities. We take them all on a financial journey. But, how do we get there? First off, with every single client, we spend 6 to 8 weeks finding out and understanding what they already have. Then we start to plan together on how their financials could look in the future. We advise them on what they need and how we can meet those needs. We're not just an advisor, we're an administrator. So we administer many of the things they need through pension, through trusts, property, private equity. We manufacture some of our products where we know our manufacturing is the best. We operate many of our investment solutions, and we operate those investment solutions as an advisor, as a manager, and as a manufacturer. In order to create great client outcomes, we believe being responsibly integrated is the way forward, doing more of what a client needs in-house. The business was set up 30 years ago in my tastefully converted garage. We floated the business in 2005. For the first 10 years of our life, we were a very specialised pension consultancy business. We didn't do at that time all the things we do now. And our client demographic was probably limited to about 100,000. There were 100,000 owner managers who could have used the range of services that a young Mattioli Woods had created. And they were generally small self-administered pension funds. And towards the back end of that first 10 years, self-invested personal pensions. We now continue to be that pension consultancy, but we do very much more for our clients. If I look at our investments, we offer private equity. We offer venture capital funds through our business at Maven and through co-ownership of our business called Amati. We have MW Discretionary, which pulls all our clients together. We manage 15 billion of total clients' assets, many of those single pounds from a revenue perspective and from a client perspective, we touch more than once, sometimes twice, 3 times, 4 times, 5, 6 times in some instances, where we're acting as advisor, administrator, investment manager, property advisor, trust operator. Having all those various revenue channels, we believe makes us really robust. Our aim is to be successful in good markets and in bad markets. I think without doubt, last year was one of the most complex in wealth management, certainly in my history. I'm 60 years old and I've been in this industry for 42 years. So I can remember 87. It wasn't like that. I can remember 99 going into 2000s. It wasn't like that. 2006, 7 and 8. It wasn't like that. Last year was a one-off, and it was very complex. So to actually get through that year, good, with strong organic growth, having made one or two smaller acquisitions, puts us in good stead for the future. We try to do as much in-house to meet all our client needs. The integrated multi-touch point is designed to help clients. It creates understanding at all client levels and within their families. And that's really important for successional planning. You know, when our original clients pass away, we need to be in position to manage their children's affairs. And often already we're dealing with the original clients' grandchildren's financial affairs. Being integrated, better service levels and continuity. And one of the key reasons we believe in the integrated multi-touch point business, it helps to reduce clients' costs. Our clients can generally get all they need from us without going to 5 other different businesses who have all got their own different charging points, head office costs, shareholders, dividend payments. We are one organisation which tries to do as much as possible for each and every client. Let's not forget, not only are we in business to make money, but it's got to make us all happy. I know the way we are integrated is good for clients. It's an enjoyable journey for them. And also it's an enjoyable journey for us. We've been able to build up some great long-term relationships. In my case now spanning back over 40 years in some instances. If we look at our multiple revenue streams, these include advice, administration, where clients have got issues, they come to us for our technology and technical support. Investment products, investment advice, banking. Because we operate multiple touch points, we can actually tell a client to go and invest their money with national savings rather than just being equity based. We offer insurance. We run a portfolio of about 6 billion of commercial property through our various hats. That needs insurance. We deal with health insurance, life cover, pension consultancy, and our employee benefit business continues to grow and be successful. Individually, they're all quite easy, but when we package them all together, what I think it does, it gives us real strength. We also, and this is a little bit complex, we work on what I call a fulcrum. We know markets are going to move around. Sometimes they're going to be good for us. Sometimes they're going to be bad. By being integrated, we can make sure our fulcrums work for us. Last year, as Ravi will run through shortly, you will see that our ad valorem investment fees are down about 3 million. The fulcrum to that is that during that time period, clients asked more of us, more advice. So our advice line was up 4 million. And we often see the reverse of that in good investment markets. The ad valorem fees are high and clients generally take less advice from us. We also saw a bounce on that fulcrum for employee benefits. Last year, if you're an employer, it was all about retaining people. That's where good quality employee benefits come in. We've continued to develop our employee benefits business over the last 5 years. During COVID, to make sure that we're in this good place now of being modern and able to deal with most employees. Many of our competitors are linear. They only have one thing that they do for a client, possibly two. The team and I prefer our multiple revenue streams. It's a bit more complex to understand. It's a bit more complex for analysts to put down on paper. But what it does create is a long-term sustainable business. If I now turn very quickly to our future, we aim to grow. Businesses that stand still generally die. Organically, we aim to increase the number of our fee earners, and that's throughout the group, in advisors and consultants, to continue to build our multiple revenue streams. Organic growth for us, as Ravi will run through, was the equivalent of a medium-sized acquisition last year. Organically, we look at our growth, that is our cake. For most businesses, their cake is acquisition growth, and we see acquisitions as our icing. We will grow by acquisition. We want to do more of what we already do, but we also want to add complementary things, more of the things that clients needs. That might be wills and trusts. It might be probate planning. We've set some really important goals. You know, we're aiming to be a 300 million revenue business. And Mike and Ravi will tell you how we're going to get there. And we will get there because every goal we've set historically, we have achieved. Because we are integrated, the business is a bit complex, but it is sustainable. It is profitable and has been for 30 years. It is ethical and it is trusted. Being vertically integrated, I sort of, the analogy is total team football rather than just 11 players running around aimlessly. We do it that way because our clients like it, and so do our internal people. So I'm now going to pass you over to Ravi, and Ravi is going to run you through the main headlines in the business, and then Mike is going to follow on with strategy and how we're going to get to our goals. Ravi, over to you for the highlights.
Thanks very much, Ian, and good afternoon to you all. It's a pleasure to speak to you on this platform today. So running through some of our highlights, there's a number of things that we can touch on, and Ian's covered a number of those already. If we first start with revenue, there's a couple of numbers that you heard Ian refer to just now, but our revenue of £111.2 million represented a growth of some 3% on the prior year, and that is in a complex marketplace. Within that, our organic growth was still strong at 4%, which, as Ian has already said, represents the equivalent growth at around £4 million of our turnover of a medium-sized acquisition. Something that is worth mentioning in our revenue profile is that we have high recurring revenues. We have revenues of close to 91% that are recurring, that give us sight into the future in terms of revenue profile and gives us longevity of that revenue stream for future years. Taking a look at earnings, adjusted EBITDA, which is our key metric for profitability, we believe the adjusted measure is the appropriate one given the number of changes to performance each year. The underlying measure of performance being adjusted EBITDA grew to 33.2 million, and that was with a margin at 30% or just under 30%, which is where our short to medium term guidance on margin will be. From a cash and balance sheet perspective, Our cash balance at the end of the year was strong at 45.1 million. The main delta on the prior year being acquisition of one of our most recent purchases of Doherty's pension and investment consultancy. We are cash generative with 37 million pounds worth of cash generation, and within that we have a regulatory capital surplus of some 75% over our requirement. Some of our other KPIs make some interesting reading. Ian referred already to our total client assets, which on a single pound basis represents 15.3 billion pounds, a growth of some 3% on the prior year. And something worth mentioning that within that 15.3 billion pounds worth of assets, given our pensions heritage, we paid out over 172 million pounds worth of benefits to clients in the last year. And that gives us real pleasure in seeing our clients who we've seen work through over a number of years start to enjoy the fruits of their executive careers and start to enjoy their pensions and draw down upon those. The other key performance indicator that we'll talk to, and Michael will talk to this in some more detail, is that our revenue generating consultant numbers grew in the year from 162 to 166. Now that measure is a new measure. It encompasses a number of things. The first and principal group in that number are our advisory team, what we call our consultants, that represent around 130 of that number. In addition to that, given our group, our responsible integrated group, we have a number of other teams in the business that contribute to revenue. If we think about the Maven business, we have deal makers and revenue generators in that business that contribute to our revenues. We also have other revenue streams around insurance, property management that are included in that. And in the most recent year, the banking revenues that we earned also contribute to that outside of that consultancy arrangement. And over time, we expect that revenue generator number to increase year upon year. From a new business perspective, we onboarded 1,100 new clients in the year, just under 1,100 new clients. And that represents effectively a medium-sized acquisition. The likes of a Ludlow is represented in that. And to be clear, that measure is a pure number. These are people that we do no business with yesterday that we now know today, as opposed to top-ups of existing clients. So these are brand new clients to the group, and we expect that to drive organic growth in the future. And then a number I'll come on to talk to later is another new metric that we've introduced this year, focused on some of our more recent acquisitions. But we've delivered from the likes of the Maven and the Ludlow acquisitions synergies of around 1.3 million pounds. That breaks down primarily into revenue synergies, and around just under a quarter of that is, or just over a quarter of that is cost synergy. The principal factor there being revenue synergies from integration between the businesses and with the group. And then on a per share basis, basic earnings per share was 14.9 pence, adjusted earnings per share was 48 pence. And given the growth of the year, given the growth expected to deliver this year, we're proposing a final dividend payment of 18 pence that gives a total dividend for the year of 26.8p, a growth of some 3%. So looking in detail at some of the financials, and we're taking a step back for a second, what we've shown on this slide here are two things. On the left, you have revenue, and on the right, you have adjusted earnings per share over a 5-year time horizon. And what you'll see there is the compound growth in revenue and adjusted earnings per share was 14% and 18% respectively. So over 5 years, double-digit growth, and it's almost the perfect graph to show, with a big change being 2 years ago when we acquired Maven and Ludlow, that step change our business. So not only have we been able to increase revenue, we've also been able to increase earnings. Revenue has focused on organic growth, and we'll talk to some of the metrics, as we already have touched on, and we'll come on to in a second, but punctuated by organic growth in a challenging environment, in a challenging marketplace, coupled with consistent, clear, and tight cost management, whilst investing in capacity and whilst also investing in efficiency for the future and for future benefit So managing costs, but still investing at the same time, as we have done over the last 30 years. In addition, our acquisition track record, which is now some 35 acquisitions deep, have all been earnings enhancing and have all delivered synergies. So they add to that growth that we've seen in the year, and they add on top of that organic growth to earnings. If we take a brief look at revenue, Ian touched on these numbers a second ago, but we see actively that revenue fulcrum in operation over the last year, as we have seen it in every single year of our existence. But specifically, in the year just gone, we saw the first two blocks where the fulcrum was come to fruition. So as markets were challenged, as asset values were challenged, and as a reference point, our discretionary proposition, our discretionary portfolios saw a fall between the start and the end of the year of some 4%. And that was punctuated by higher and lower periods in the year. But that 4% reduction led to a overall reduction in ad valorem revenues, or those revenues linked to asset values, of some £3 million. But in that challenging environment, we saw advice increase significantly across the pensions consultancy and administration segment. We saw that advice deliver an additional £4 million of revenues, supplemented by an additional £1.1 million of revenues from our employee benefits business, as businesses start to realise that retention is key, and therefore you have to offer staff more things in their remuneration packages to keep them. In addition, we saw growth in our property management team, in our property management segment, I should say. And that again is in an environment where property values were challenged all year, but the launch of several private investor clubs opportunities in the year saw us generate additional fees and generate growth year upon year. So I've already talked to organic growth, and I've already talked to high recurring revenues. The third feature I'd like to discuss is our sales mix, or revenue mix. And that distinguishes from similar businesses, whereby 37% of our revenues are fee-based rather than ad valorem. And that gives a natural protection in down markets against the reduction in asset values, and also we're able to share in the upside when markets improve. And in the bottom corner, very briefly, what we've shown there is our acquisition performance from our 5 most recent acquisitions of Maven through to White Mortgages. And what this shows is the performance. What we should actually show in this graph is the year before, but it shows the relative performance of each business from a revenue perspective. And in the 2 years from the year before to the 2 years post acquisition, and in each of those 2 years, we've seen revenue grow in all businesses. There's a slight nuance in Maven, whereby the expectation was to deliver £21 million worth of revenue. We had an exceptional year one, and delivered 26, the best ever year Maven's had. In year 2, the second best year Maven's had, we delivered £23.1 million of revenue, but the trajectory is still positive and up for all businesses. Turning briefly to the adjusted EBITDA bridge and our adjusted earnings bridge, what we saw there was a growth from £32.6 million to 33.2. As I've already said, our margin was maintained, and we saw a number of things. We saw an increase in our employee benefits costs, or our staff costs, as we refer to them, driven by an increase in recruitment in the prior year, annualizing into FY23. We saw additional investment in capacity, and Michael will come on to talk about this in a second, around what we're doing with our advisory program. And we gave all staff an initial cost of living bonus of around 3%, a pay award for all staff, and then based on these results, there'll be a discretionary bonus that is paid. There's all factored into that £3 million additional cost. We're able to offset a lot of that with tight cost management, and we saw a reduction in what we call overheads for categories such as lower legal and professional fees, lower regulatory fees, which is primarily driven by the FSCS levy, where for the year just gone, we saw a reduction. There's various schools of thought that would increase in the future, as it has done in the past. But for the financial year ending May 23, we saw a reduction. And we also saw an overall decrease in overheads. Focusing very briefly again on the acquisitions and the acquisition performance, very similarly to how I said about revenue. In the charts there, we've shown the pre and the post acquisition adjusted earnings per share profile for those three businesses there. And in all cases, you see that with the Mattioli Woods Group support, as part of that group, all acquisitions have delivered growth year upon year in both revenue and earnings. And all of those businesses are delivering to at least plan, and in two cases above expectation when we acquired. So we're fueling an additional growth with Mattioli Woods, which have been driven primarily by the synergies that I referred to earlier, the revenue synergies coming through. So we're seeing direct cross-referral of work between Mattioli Woods clients and Maven clients. Maven, one of their reasons for doing the deal was to increase distribution and to increase funds flow to those business deals that they have. We've been able to facilitate that, and we're seeing Mattioli Woods clients invest directly in or invest into a milestone fund, which will then invest in a number of private equity opportunities. We've seen the Ludlow business invest directly into Maven. We've seen the Ludlow business invest directly into our core DFM proposition. And as I also mentioned, we're seeing those three businesses refer work to employee benefits. So those revenue synergies are really coming through in strength, and we expect that to continue next year as well. From a cash generation perspective, we remain highly cash generative. We generated £111 million worth of cash in relation to EBITDA. The primary reason for the change year upon year was lower acquisition costs. And from a working capital perspective, we saw an increase of requirement driven by provisions. The provisions are in relation to our deferred consideration, with the two main deals that we are providing for being Maven and Ludlow, with Maven having 3 years to pay at the end of the financial year. In reality, it'll be 2 after this calendar year, and one year left for the Ludlow earn-out. From an adjusted earnings per share perspective, we saw a small fall to 47.8 pence per share, and that was driven by the timing of the issuance of equity to fund the Doherty's acquisition in Q4 of financial year 23. So issuance of equity in Q4 without the full earnings profile, we expect that to unwind this financial year and to return to parity and to growth. And as I mentioned earlier, given the confidence in what we've seen delivered in financial year 23, what we expect to deliver this year and what we expect to deliver in future years, we're pleased to recommend a higher year-end final dividend, leading to a total dividend of 26.8p. And from a compound growth perspective, since IPO, our CAGR on total dividends has been 17%, and over the last 7 years, that compound growth has been 10%, and we're committed to a progressive dividend policy, which remains well covered at just under 2 times. So now, having talked about financials, I'll pass you to Michael, who'll talk about the business and our growth program.
Good afternoon, everyone. Ravi Tara, it's a pleasure to be speaking to you. Before we talk in too much detail about the benefits of the integrated business model we operate that he mentioned at outset, I want to remind everyone of the really exceptional market opportunity. Whilst the business itself and our clients and investors are suffering some headwinds or short-term headwinds in terms of asset values, the drivers for growth in the UK wealth management space are really quite interesting. And we've got an aging population who are focused on retaining wealth and utilising that wealth to support themselves for longer. We've got a situation where final salary schemes are no longer available within the marketplace, that everyone's having to work on DC schemes and determine their own financial independence. We've got changes to fiscal policy, some positive, some negative, but either way, they all require advice. And more recently, of course, clients managing their income are having to deal with inflationary pressures and understand which assets to invest within. Our model has developed through us addressing more of our clients' needs. Exactly as Ian mentioned at outset, clients do not want to be dealing with 2 or 3 or 4 different people when managing their wealth. They want one trusted advisor who acts with integrity. As Ian mentioned, we're an advice-led business, providing financial planning and advice to individuals and their families, and employee benefits to corporates and assisted trusts. This stacked Venn diagram describes the nature of the assets that we have within the business. So we look after £15.3 billion. Within that, we have advisory relationships of 11.4 billion.
So hopefully you can hear me a bit better now. But as I was saying, we're £11.4 billion of assets within our advisory relationships. 9.8 billion of them are on the financial planning side, and £4.8 billion of these assets sit within our own investment solutions. What this provides for is multiple routes to market. Now we can win clients through any of these approaches, but it also means we change the same or touch the same pound of revenue on numerous occasions. We control more of the value chain, and I'll come on to why that's so important in a moment. If we look at our clients through, or look at our business through the lens of the clients, what you can see here is we have set out our stall to deal with clients with higher, more complex advisory needs. But we can also address clients with smaller assets in the growth phase, both commercially, and provide for them a great commercial outcome. What we also see here is that the great like-minded businesses that have joined Mattioli Woods share the same client profile. So the top line there is core MW, which is clients that we as a business have won organically. As Ian mentioned, that's so important to the business. We won 1,100 clients organically last year. What's below is the clients that have joined us for other great acquisitions like Ludlow, below that, Pole Arnold, Doherty's, and you'll instantly see the client profile is very, very similar. Now on the top line, that's 7 billion of assets that sit with core MW clients. They are assets that utilize more than 1 or 2 or 3 of the services that Mattioli Woods provide. Whereas the assets within Ludlow, the assets within Doherty, they are looked after by really extraordinarily good advisors, but they only capture one revenue stream, being financial planning. Over time, if they utilize more of the business's services, we can gain more revenue from those asset bases, and the client can gain a better financial outcome. Now, that can't happen overnight. We can't go to all of the Ludlow clients and say, all of those investments that you were in for the last 10 years, they're not quite right anymore. But what we can do is assist the advisors and the clients over time to understand that the solutions we've created, the solutions that we are passionate about, provide them with better outcomes. And we're already seeing that in part, which I'll come on to in a second, through the investment mix that we offer. As Ravi's already mentioned, in order to take advantage of this opportunity that is in the marketplace, we need capacity. Now, within the business, we've always believed we need to build capacity for the future. We're a business that is planning for 5, 10, 15 years, not for 12, 24 months. We're also a business that is now much more of a group than just a collection of financial planners and employee benefits, with that multi-revenue streams of business that I mentioned a moment ago. So when we describe our fee earners, we need to describe them in that terminology. So here we have the financial planners and consultants in the group that I'll come on to in a second, but we also have the other fee earners, the deal makers at Maven, the fund managers at Marty, well, not a Marty on this draft, but in-house at Mattioli Woods, and also those who manage our banking proposition and our insurance proposition. And what's really important for us to understand is that capacity now exists. If we doubled the amount of money in our investment solutions, we wouldn't need 2 or 3 times the amount of people in the team. With very, very small increments in personnel can leverage up these elements, these revenue streams. In order to do business with people tomorrow who we don't know today, we need to continue to build out and develop our consultancy team. But unlike the majority of businesses across the UK, we train and develop our own consultants, and have done since I joined the business over 20 years ago and before that. What that has meant is in Mattioli Woods, the average age of our consultants is 40 years old. The average age of a consultant in the industry is 60 years old. It also means we have a much more diverse collection of advisors from a whole range of backgrounds who are able to empathize with a wide range of potential clients. It's how we've driven that 1,100 new client wins. And these are individuals who are trained to be enterprising, but importantly, they all have capacity. What you'll see in a wider marketplace very typically is advisors who have the ability to generate revenue and get to a revenue capacity of somewhere between 250, 300,000 pounds, maybe 400,000 pounds. Now, we've seen people who've joined our business with those type of turnover amounts. Within Mattioli Woods, servicing the same clients to an even greater standard, offering those clients more services, utilizing more of the things that Mattioli Woods provides, so that we gain more revenue across the value chain, that can be 3 or 4 times as much. Our top consultants across Mattioli Woods generate £2 million of revenue. So when we look here at the advisory team we have, anyone below £750,000 has the ability to gain more revenue and take on more clients. And we'll come on to later why that's so important in terms of achieving our targets of £300 million of turnover. I mentioned a minute ago about the revenue streams that come into Mattioli Woods and the opportunity for us to garner more than one revenue stream across the asset base that we have in Mattioli Woods. And the top part of this graph is designed to represent that. You'll see in the red bars the £9.8 billion of financial planning assets that I referred to earlier on. To make these numbers tally up with the numbers we have under asset management, there's an additional £1.8 billion of assets that sit with other providers. Because let's not forget, other advisors, other clients, other institutions utilize the solutions that we have created for our clients. So dropping down to the second bar here, what you'll see is of our £9.8 billion of assets that we have the financial planning mandate over, that we are the key relationship driver, 2.9 billion of that sits in our financial solutions or our investment management solutions. The pink bar on the far left is 3.4 billion pounds of self-invested assets. So very typically commercial properties, loan backs, the origins of the business that Ian mentioned in his intro, but still very much an important part of the business today. Well, a lot of those properties that were bought with loans 15 years ago have repaid those loans. So that rent that's coming in is investable wealth for the future. So it feeds into other service lines. But most importantly, that 3.4 billion pounds of assets that sit in the middle there, are assets that are with third-party investors that is potential revenue that should come into our investment, so a potential assets that could come into our solutions and we could gain revenue from. Of our 4.8 billion pounds of holdings, 1.7 billion pounds sits in our own fund management solutions. And some of those solutions contain and cater for very significant annual fees because they're so specialist. Now, 800 million pounds of our assets sit with Maven, a business we bought some 24 months ago. Now, Maven offers private equity solutions, very, very specialist deals. They sit right at the top of the pyramid, the risk pyramid investment solutions. So no client's got too many assets in this one solution, but that solution itself provides for very, very high margins, and clients are willing to pay it because of the specialist nature of that solution. Moving on now to our administration platform. The key here, and we're sometimes asked, well, why do we continue to do administration? If you can do advice, if you can do investment management, and both of those carry higher revenue streams, and administration probably as an offering under pressure in terms of revenue, and then in turn in profit, why continue to do it? Well, administration allows us the platform to support all of the advice we're offering. Also, as a business, we're very much more efficient at it than a number of our competitors, and certainly much more efficient at it than when we started and we came to market. An administrator now can manage 82, 83 clients or pension schemes rather than the 40 when we listed. Also, administration is a great source of talent for the future of this business. I was once upon a time an administrator. I looked after clients. I understood the needs of how to undertake transactions, and it made me a better advisor. There are also the potential for revenue streams to come from our administration offering. For instance, clients get a better banking facility in the new banking offering we're providing, which ultimately will lower fees, so assist with the margin pressures, but allows both us and clients to benefit from a higher level of interest. We've got £6 billion of assets within our SIPs and SAS that we insure. So it's an insurance premium that comes through to the business. And we can continue to build all of these solutions out into the future. So it also provides a platform for future growth. Just a little bit conscious of time now. I want to spend just a couple of minutes talking about our strategic plan before I pass back to Ian to sum up, and then we hopefully can go to a little bit of Q&A. But as a business, we've always believed in setting goals. We believe goals create the right level of ambition and discipline across the group. And it sets the tone that people know you're in growth mode. So it helps us retain talent. They work out that if we're in growth mode, there's more opportunities for them in the future. And it also makes us as a business, and it's exactly what these events are all about, sit down, look at what we're doing as a group and work out where and when we can drive improvements. 2 years ago, when we completed the acquisition of Maven, we achieved our previous targets and got to a £100 million turnover business. So at that point in time, it was appropriate to reset our targets, and we believe we can be a £300 million business with £100 million of profit over the medium term. We are, exactly as Ian and Ravi have both mentioned, an organic growth first business. I think Ian coined the phrase, organic growth is the cake, M&A is the icing. But both of these things are interrelatable. Now, we know that we need to grow the amount of advisors that we have within the group in order to win more clients. So what we're doing is implementing a training academy. We've always had a training program. I mentioned it just a moment ago, but we're able to transfer and increase the capacity, or transfer to more office-based systems, more mentoring-based systems, and increase the capacity of the training academy. So last year we were putting through 4, maybe 6 individuals every 6 months into our training academy. On the 1st of December, we have 15 people who will start our training academy. Now, there may be an element of increased attrition in that, but the output will be significantly higher. And as I mentioned, we think the opportunity for us in the advice space is so significant, we can utilize that capacity extremely well. And I'll come on to how the M&A can also drive organic growth in a second. Employee benefits, both Ian and Ravi have mentioned it. Employers need to work harder to retain staff at the moment. So we're seeing more and more employers instruct us with EB mandates. But more importantly, we've got 10 years of growth since final salary schemes were phased out. DB schemes became the centerpiece via stakeholder schemes. Each of those small schemes 10 years ago are quite substantial schemes now, and some of them require further advice. Investment management, we've seen a fair amount of pressure on asset values recently. For us as a business, that's okay, because when ad valorem fees come down, more clients take advice, we can maintain our revenue. But because we offer administration, we don't lose those assets that haven't been invested. We keep them within the MW group, within the MW family, and we can redeploy them later. And the fact that we have these investment solutions, the fact that we have Maven, means that when we bring businesses together, they can utilize more of the group's offering, and therefore we can gain better revenue from the assets whilst the clients get better outcomes. And then just finally, to talk about M&A before I pass back to Ian. The financial planning space in particular is a very, very fragmented market. I mean, we are probably one of only 10 firms in the country of more than 100 advisors. The last time we looked at the stats, there are only about 30 or 40 firms with more than 20 individual advisors. The vast majority of financial advisors across the country are one-man bands or part of 1 or 2 or 3 women financial planning companies. Now, because the average age of that is 60, there's a great deal of them, a great deal number, who want to retire. So all that capacity that we're building up, that I mentioned a moment ago, that we're mentoring through our business units, that we're developing as individuals, they can help these IFAs who want to retire by offering the capacity to absorb those clients. They actually very often better develop those relationships than the 60-year-old advisor, because our 40-year-old advisors can also interact with the next generation. And we as a business retain 97% of our clients, even on death, because we've got different age ranges across the group who can capture relationships of mum and dad, daughter and son, granddaughter and grandson. And that's really true in this smaller M&A space. So it becomes a very, very useful tool, even though the market's very, very fragmented. We will continue to look at medium-sized deals, maybe in a Q&A in a second. We can talk about multiples. There's a lot of private equity money in our space that are making the medium-sized companies perhaps a little bit overpriced. We are a very, very disciplined acquirer of businesses. So there are occasions where the manager's preferred, we're almost always the manager's preferred bidder, but not always do we win the competitive processes, but we do win a fair share. And then we'll continue to look at the larger transformational deals, but they bring with them more complexity. So for us, it's very much about organic growth first, growth stimulated by smaller M&A, and as and when appropriate, bringing in these medium-sized businesses. So I'll pass you back to Ian now. Apologies for the slight technical hiccup in the middle, but back to Ian for the business case.
You know, we set out this business 30 years ago to be robust, and it's still robust. You know, we've now potentially got about 15 million people in the UK that could use the range of services that we've created over the last few years. Now, we're not going to do business with all of those 15 million, but what it's showing is that our USP, which I think is our distribution, will be able to win new clients year on year. It's really quite distressing. I've been in this industry for 42 years and I still qualify as the average. You know, I'm 60. We've spent so much time, effort and energy in creating experts, in creating a passionate team. So it really is a luxury to have an average age of consultants at Mattioli Woods being 40. The business has generated great profits, but that's not at the expense of not being able to deal with conflicts of interest. It's not been at the expense of client outcomes. You know, we put ourselves in the client's shoes all of the time to make sure that the outcome and the things that we do for them are logical, sound, appropriate, needed, and of course modern. Owning our own distribution, we don't rely on others to give us business. You know, we go out there and find it, and you can find it if you are a good brand, if you're trusted, if your clients will introduce existing friends and colleagues into the business. Our saying is we look after other people's money, therefore there is an expectation we should be able to look after our own. And during COVID, we did that very well. And in a, you know, not a brilliant year, yes, last year, you know, we've done that exceptionally well. Our organic growth, you know, the equivalent of a mid-sized acquisition. We could, I'm sure, make higher profits if we stop doing some of the good things. We could slightly worsen a client's outcome. We could stop our training. We could have lighter governance and oversight. That'd look good for a year or so. It'd make us all feel miserable, I have to say, if we did that. But in 4 and 5 years' time, we'd fall off a cliff. And, you know, maybe we will just see some other businesses do that, because I know their expenditure on technology, their expenditure on training, mentoring, governance and oversight, they're not spending as much as they should because of the drive for profit, immediate profit. We're here for 30 years. That is our client's expectation. We grow organically and we grow by acquisition. Acquisition is the icing, not the cake. We've set out our goals. You know, historically, we've always done that. When Bob and I were in the garage, we set goals. A few years back, we set some more, which we achieved a couple of years back now. The new goal's 300 million. You know, we think we need about 300 consultants. You know, we've got 150 of them already. So we've got to grow that out over the next 4 or 5 years. We've got to raise the profile of those consultants to be able to generate better revenues without worsening the client's outcome. We set those goals, as Mike has said, you know, to make sure clients are aware of what we're trying to achieve, to ensure that they understand our margin isn't taking too much money out of their position. Our ambitions today is as strong as they were 30 years ago. And, you know, I probably accept I won't be here for another 30 years. But I know the next 30 years are going to be brilliant because the team is so aligned to what Bob and I tried to create and have created over those 30 years. So thanks everybody for attending the seminar. I know there's some question and answers. I'm going to pass you back to Hannah.
And thank you for that presentation. Right. You now have quite a diverse investment offering for clients, Marty, Maven, etc. Are there any investment gaps that you would like to fill?
There probably always will be. We'd like to see, for instance, better use of our sort of ESG sort of investment position. We'd also like to see a band of investments which are linked maybe to ETFs. And, you know, one of the reasons that our chairman, David Kiddie, stopped being a non-executive independent chair was that so he could come across to the executive side and help us and give us all his knowledge of the last 30 years of building a better and more succinct investment house. So we do the holistic wealth management brilliantly, but we know there are a few gaps in our investment proposition, and we'd like to build those out. So I think it's probably safe to say, watch this space on how we develop. We're talking to quite a few internal and external people. Okay. So watch this space on that one. Yeah.
Thank you. Well, I guess leading on from that, then the pricing of acquisitions, if you're looking to fill gaps, the pricing of acquisitions in the market has calmed down. Has it calmed down at all following the frenzy of PE-backed consolidators, or is consolidation still in full swing?
Yeah, we've never seen ourselves as a consolidator. We had good quality businesses, and those good quality businesses generally come to us at the right price. The private equity style market, we heard last week, had paid sort of 19 times EBITDA for a business. That will play itself out. You know, private equity money is a little bit more expensive than it was. It's always difficult acquiring good businesses. We've historically not always been the highest payer. We generally management's choice. But, you know, set that all aside, you know, last year in not a great year, we grew organically by the equivalent size of a Ludlow. And, you know, let's not forget, you know, we paid 30 million for Ludlow. So, you know, if we can get our organic growth back up to, you know, 8s, 9s, 10s, you know, dare I say 11s and 12s, you know, if we can achieve that, you know, that's a business worth 100 million, which we're adding on each year organically. So it's the combination of the two.
Okay, thank you. Consumer Duty, obviously a new introduction. Have you assessed all of your solutions as value for money for the end consumers?
Yeah. We started out on that 30 years ago. We were one of the original disruptors. So, you know, Consumer Duty for me is quite easy because in 42 years of in the industry, I've always put the client first. And, you know, Consumer Duty is all about their security and their asset security. So, you know, for somebody who comes from an administration background, you know, just keep more and more governance and oversight coming to us because we can manage it and deal with it. We can deal with all the conflicts that emanate from that and make sure that our clients' money is absolutely as safe as possible, and they and their families understand what we do for them as much as possible in the most cost-effective way. You know, in the last, I think it's 4 years, we've actually reduced our clients' charging to the tune of about £5 million. We didn't need to do that. They didn't ask us to do it, but we knew we could actually be more successful by giving them a little bit back and us moving forward in a slightly different way.
Thank you. Perhaps one for you, Ravi. Surplus capital on top of regulatory requirements has dropped off quite a bit. Does it limit acquisition strategy? And is there a reason debt can't be used to fund acquisitions?
A number of questions there to think about. The main reason for the reduction year upon year was the fact that we acquired the Doxy's business and paid around £50 million for that. So that was a natural reduction of that capital balance. In terms of limiting future acquisitions, no, I don't think it does. Whilst regulatory capital sets a limit, I think, as Ian just said there, for the right acquisition opportunity, there's a number of things we could do. One of which would be to consider the use of debt. I mean, it's, as a business, it's not something that's preferential for us. We'd like not to have debt, or like to have a clean balance sheet, I should say. But equally, in talking to brokers and talking to a number of investors over the last few days, what we realise is that whilst markets are challenged, for the right opportunity, the markets aren't closed, and we could come back to market for additional funding should we find the right opportunity. But that is balanced with everything that Ian has said, that we'll do acquisitions, but with discipline. So we won't force a transaction for the sake, we won't force that icing. We'll focus on the cake, and wait for the right opportunity, the right price, then we'll come back for future funding should we need to.
Okay, thank you. Perhaps back to the sort of a consumer duty point here. Obviously, there's a focus on cross-selling internally. Does that bring with it an increased conflict of interest risk, with the advisors deemed not to be independent?
I mean, that question again we've been addressing for 30 years, in acting on all the things we do, and it is fundamentally, where there is an absolute direct conflict, you announce the conflict, you discuss and debate the conflict. However, most things are just done in the general sort of course of business. A client who sets up a pension fund needs an administrator. The fact that it's an administrator which is in-house, is that a conflict? These are all sort of questionable sort of areas, and ones we have to deal with all the time. Being a trustee of 12,000 trusts, you are dealing with conflicts within the trustees all of the time. We have not been independent for many years. We are independent on our investments, but not necessarily independent on sort of product. Now, that still doesn't mean that we don't ever use anybody else's product where it's better. So the best example I can probably give you of that, in our discretionary portfolios, we have significantly more of other people's REITs than we do of custodian REIT, which is deemed to be a Mattioli Woods style product, even though it's an investment trust. So, you just manage your conflicts ongoing. When we run a pension fund and there's 3 directors in one scheme and they fall out, we will often retain each director. Sadly, couples do, change and they divorce. We will typically retain both sides of that equation as clients going forward. So, we've been able to deal with conflicts over many years, as well as anybody can, because, as an advisor, as an administrator, if you take any money away from your client in the form of a commission or a fee, you create a conflict, don't you?
And I think as well, Hannah, what we very typically are is about as transparent a business as you'll probably come across. We started the business on a fee basis before the world had really heard in financial space of charging us fees. Everyone charged very large commissions. We started the business, Ian and Bob started the business charging fees. We continue now to be as transparent as is humanly possible on every single fee we charge. So the clients have very clearly got an understanding of where the value comes from, and how in managing these conflicts, we're providing them with a better outcome.
Helpful, thank you. Right, you've talked about the benefits of your younger advisor base, but how long does it take for a newly recruited young advisor to break even? And is it clear that those who've trained with you from the start become eventual high fee earners?
Yeah, I mean, just being conscious of time, I'll probably I could spend probably 5 or 10 minutes on that because it's a great question. But the people who join us as young consultants are actually doing work on behalf of our consultants, or doing work on behalf of our administration teams. So pretty much on day one, they are at least break even, if not profitable. When they go out on the road, as we call it, and become a consultant, they still have some administration function. And we would typically say we would give sort of 2, 3, if not 4 years to get them up to a level where we know they are profitable and in line with our normal margins. But we give them the 2, 3, 4 years because it is just so difficult to find good quality consultants, and some can do it in year one, but some of our best consultants, it takes them 2 or 3 years to settle into the role.
Understood. Thank you. Can you explain what benefits you bring to an advisor business that sells to you?
Yeah, I'll take that one unless you want to deal with it, Mike. But you know, when we sit down with an advisor business, they've got to the stage where, you know, that they've got long-term relationships with their clients. Often they've gone from the client phase to actually, you know, deep long-term friendships.
Yeah.
So, you know, what we can bring to the table is a team of people who are passionate, who are caring, and who will look after their clients. We did our first acquisition about 20 years ago. And, you know, to this day, we still look after 90% of that client book. We very rarely lose clients on the back of acquisitions because we put a team of people around the business which cares and can actually produce. Some of the people we take on through their own business, they're a bit log jammed. They don't really like governance. They don't like compliance. Their investment sort of position has become a bit complex as a small business. And we bring them on board, and then we take the governance away from them. We take the compliance. We've got good investment solutions, and they go, oh, you know what? I'm really enjoying seeing clients again. So some of them, even though they say they're going to retire after a year or so, start to enjoy it again and become very productive. And, you know, we've got people, you know, who are still working for us who said they were going to retire, in Jim Tennant's, 7 or 8, 9 years ago. Jim said he was going to retire, and I think he still does a bit of work every now and again for the business, which is just what we want to see.
What exactly is the pension banking product?
So what we've got in the business within the administration platform is 11,000 SIP and SAS that have audit accounts. And audit accounts across the industry in the pension sector are still by their nature very paper driven, which actually creates quite a lot of unnecessary administration. So what we're doing as a business is repositioning the audit accounts to allow clients to have a more digital offering. So parts of the banking project that we're undertaking is just modernizing our banking facility. And what it's going to allow us to do is lower clients' administration costs, make administration quicker, faster, and easier, and generate a better rate of interest for our clients. And we can share a bit in that revenue stream as well.
Yeah.
Great. All right, last one. Could you explain in more detail what the X-Plan CRM system does and why it's so much better than what was in place before?
Yeah, I'll start that one and then probably pass over to Ravi for the figures. So many businesses in financial services have spent absolute fortunes, you know, 100 million plus, on trying to create a bespoke whiz-bang system. We've created our systems internally over 30 years They're not going to fall over tomorrow. However, as the group has expanded, we need a centralized CRM sort of hub. Now, we don't need it bespoke, because what we want it to do is just churn out information so that when Mike receives it, or I receive it, or other of our consultants and fee earners receive it, they can tweak it a little bit themselves. But we don't need the tweak within the system itself. So this time, rather than trying to build it all ourselves, it's a plug and play. It's an existing system. The existing system is used by about 60% of the wealth management industry. We've already started to apply it to existing group businesses. So smaller businesses that we acquired 3 or 4 years ago, they are now already working on our new X-Plan system. And, you know, touch wood, because you have to touch wood when you re-platform in effect. It's all going well.
It is,
financially. I think it's okay as well.
Yes, it's all running to budget and to timetable. In terms of investment that we've made in the last year, it is around just under £1 million worth of cost on the implementation, which we expect to be a similar amount for this current financial year at just over £1 million. And in terms of that spend, it breaks down primarily to external support that we're bringing in to partner with us on the implementation. And then after that 12-18-month journey from here, that will transition into a license cost of around £900,000 a year. That will be an ongoing level of cost. The only reason for increase then will be as we increase advisor numbers over time. But on a like-for-like basis, it will be circa £1 million this year and into the future. Yeah.
Extremely helpful. Well, that's it, gentlemen. Thank you to our listeners for attending. A reminder that if you could please fill out the feedback form when I finish this webinar. Thank you to the three of you for surviving through your tech, and we look forward to hearing an update in 6 months' time. Thank you.
Thank you, Anna.
Thank you.
Thank you, everyone.